Tuesday's trade began with a partial recovery in the markets, equity indices up, sterling up, oil up, and the ultimate safe haven, gold, down. But in an environment where the British economy has now been downgraded by the three largest agencies, S&P, Moody's and Fitch. Where now? Sean Corrigan joins us from Hinde Capital. Sean, welcome.
Hello, thank you.
How desperate is this situation developing now? Now that we've got the three credit ratings agencies all having downgraded or given warning as well about the outlook, how do you feel about where the UK is in an investment place?
Well, to deal with this specific issue, I guess they had to take some action. The big worry for the UK is the external deficit, which is 6-7% of GDP. It's a peacetime record. In the current environment, this is easily financeable. The UK is still a country that is a major economy, still working reasonably well, despite whatever turbulence it's suffering at the moment. So I guess they had to make some manoeuvre, but does it practically mean anything in a world of zero rates? I mean, you give your arm and your leg to get 20 basis points these days, so I'm not sure at the moment that it's of any significance at all.
How about the significance of the big drop in banking stocks? George Osborne coming to the market to try and calm things first thing on Monday morning, and he was saying then in quite clear terms that the banking sector in the UK, as indeed the rest of the economy, he's obviously talking up his book for the last 6 years. The rest of the economy, he says, is in far better shape than it was in 2008. Banks are far better capitalised, they're far better protected, far better insulated. But banks have seen a massive drop in the share price. How do we look at banks now in this new environment?
Well, I think to the extent there's a merit in what he says, I think it's that this is a very different situation to the last time. The last time banks were very over-leveraged. They had all sorts of exotic derivatives that were buying supercomputers to pretend to calculate. They were all reliant on one another through the wholesale funding markets. A lot of that has disappeared. Yes, there's been some extra regulatory capital put in place, although of course the BIS would probably tell you it's nowhere near enough. We do, however, know that they're all still too big to fail. So ultimately, if it got to that point, the walls could come tumbling down. But I think this is more a question, as you see, they're attacking really the equity market than anything else. This is a question of earnings. What are they going to earn in future? So British banks have some possibility of possibly adverse currency exposures, since Britain as a whole is such a net borrower from abroad. But more than that, what people are now thinking, of course, is this means that QE, NERP either continues or indeed, heavens forbid, is intensified. Where are the banks going to earn anything from?
Why heavens forbid? What is it that's the downside? Because we've seen all this money come into the market. The ECB is a program of putting money into the market. The US seems to have successfully averted a major crisis because of the amount of money that's gone in there. I think there's £375 billion of money that the Bank of England's put into the British economy. Why putting in a bit more? Why is that going to be a problem?
But the point is, look at it from a bank balance sheet point of view. You had a reasonably safe asset which was earning you several years ago 3-4%. If you've managed to hold on to it at all, it's negative. It's been swapped effectively by the Bank of England for cash, which is, whether it's circulating in the economy before it gets to you, still piles up on your balance sheet. You lend it back, not to the Bank of England, of course, but they gave you zero for it. The other central banks charge you for it. It's a tax on bank earnings. So how is this beneficial?
Okay, all right, so if the banks are in good form, it's a different situation. Where does the economy go through from here? Because you said the economy is in relatively good shape. Indeed, I think backing up what George Osborne was saying. What catalyst or what flags do we now watch out for?
Well, of course, there's the problem with the turmoil, the political and economic uncertainty will probably have it's unquestionable, it'll have some detrimental effect on investment. The bigger question is what it will do to the consumer. Now, of course, the mainstream view is that if the consumer keeps spending and borrowing, or I've seen people this morning talking about the Bank of England just does helicopter money, gives everybody a voucher, go in the shops. I actually think this is a disaster because the sterling depreciation is what we run a big current account deficit. We buy more than we sell. We're effectively somewhere or other, we're uncompetitive in the productive sector on a grand scale. So we rebalance with the currency depreciation, but if you then add credit to the system, all that turns into is inflation. It turns into more spending on non-productive things rather than a switch from buying goods on credit from abroad to investing and working at home to build up an industry, either to replace those now more expensive exports or to take advantage of your cheaper ability to sell into the wider world. If you just pump up credit, you waste it. Like for 50 years, the Italians and whoever did in southern Europe. And exactly contrary to what we did in 1992, when sterling fell out of the ERM, it fell with a big thump, pretty much as big as this one. The reason that we had a recovery after was there was a credit squeeze. The government couldn't borrow from the Bank of England or the other banks in the same easy fashion as it can today. Markets wouldn't stand it. The QE system wasn't there. There wasn't the desperation for the assets. And we as individuals, by and large, we all got caught in the housing collapse, and we were desperate to pay down our underwater mortgages. And that meant that in the end, the devaluation went to us going to work and local businesses investing and foreign businesses investing to take advantage of it, and Britain closed its gaps, put people back to work in a sustainable fashion. If we loosen credit now, as Mr. Carney's talking about doing, I think we just we throw away the possibility of rebalancing, which we're crying out for.
Okay, how is Europe fitting into all this? We know that Europe desperately wants the UK British government, as it is at the moment, to get on with Article 50 declaration and making sure that we exit the EU as fast as possible. It doesn't look like that's going to happen, certainly in the next 10 or 11 weeks at least. How much of a threat is all this to Europe and the Eurozone, perhaps more importantly, the European single currency?
Well, I think this is the reason why bank stocks and the like have been hit almost as hard on the continent as here. You've seen Deutsche Bank take a big hit over a couple of days. You've seen the Italian banks, until this morning's possible leak of some more government support, that they were hammered. So the situation does arise. The Europeans, of course, the leaders of Europe and the arch federalists are now terrified that this is the crack in the dam, as we all know. This is going to make the negotiation process really difficult because they don't know what they want either out of this. The diehards and the ideologues don't want they want Britain to be put in a punishment battalion for daring to defect from the front. But the wiser heads and councils and the business leaders of Europe are thinking, my goodness, look at the market we have in Britain, one that we tend to sell more to than they sell to us. In a world where we're short of growth and we're casting around, we've shut ourselves off from Russia, the Middle East is a mess, China, we don't know what's going on. Can we really afford to punish Britain? So there's a conflict there for a start. And it's all very well saying get on with the negotiations, but what's the European position going to be? They don't have one.
Okay, so the investment advice, what are you telling clients at the moment?
Well, clearly this is a somewhat, I mean, it's pretty much unprecedented for this to happen on this scale. We also have the problem that because of the policy of central banks over the past 5, 6, 7, 8 years, we may have increased capital buffers, but we've also greatly increased leverage and increased risk, pushed people into higher duration, riskier assets, got people gearing up. This is the world also of HFTs and algo trading, which they don't bother to read the headlines and take a considered decision. If the price signal comes, bang, it goes. They may only exercise a short-run influence because they may well operate on the other side once the signal comes, but undoubtedly they're disabling. So you have to allow for the fact that whatever risk parameters you're running are wider now. So you have to add an extra level of uncertainty. But ultimately, if you thought a business was good 3 weeks ago, you have to go through that balance sheet, or you had a target 3 weeks ago for something. If it cheapens, I'm going to buy it. It's now cheaper. So add 10% or whatever, 15, 20%, whatever you want to the risk parameters. Look at the business, see if it's really been damaged by what we know has happened, and go and buy it. I mean, what else do you do? Blood on the streets is obviously the answer. Don't be too premature. Don't be gung-ho and rush in at the first sign of a bounce. But people in the investment community are desperate for quality assets. Yeah. They don't want to park it with a bank which is going to charge them and give it back to the central bank at negative interest. They want to use it. So while that money's there to be used, they have to search for bargains and just be slightly more cautious about it.
Okay, all right, Sean, thanks so much indeed. Slightly more cautious about it. That's a good way to end the interview there with Sean Corrigan from Hinde Capital.